Can you guys guess which company's stock chart this is? Take a few seconds and try and find out. Did you get it? This is the stock price chart of HDFC Bank, India's largest private banking company, and for the last more than 3+ years this particular company has given absolutely zero returns. Very funny, right? But what if I tell you guys that HDFC Bank might just give you a 40 to 50% return in no time in the future? Yes, this is a possibility, and in this video we are going to find out how that is so. So let's begin. So first we've come to screener.in. We've opened the HDFC Bank. Okay, and over here what do we see? Most important thing, stock P of HDFC Bank is 16.9. Now that is fine, you might think, but this is very insane for you to know that this is one of the lowest P's HDFC Bank has ever been in. For example, if I click on the P ratios and look at a max level, like from this tab, its lowest P of all time. Its lowest P of all time was also hit on February 24 when it reached 15.7. But this is one of the lowest price to earnings ratio HDFC Bank has ever traded in its lifetime. Even if you consider during COVID, when everything was supposed to end, HDFC still trailed at a PE of 16.9, which is similar to the PE it is currently now. Even in the 2008 crisis, when the worst banking crisis of all time, it traded at a PE of 17.8. And if you look carefully, at that point of time, the EPS or earnings per share of HDFC Bank was only 4.5 rupees. Okay. But what has happened to the earnings per share over the next, say, 15 years? It has grown from an EPS of 4.5 rupees to a current EPS of 89.6. And if you look at this particular chart carefully, what do you see? You see that as the EPS has continuously grown, the price to earnings ratio of the bank has continuously fallen. What does this indicate? This clearly indicates that HDFC Bank has faced a huge time correction. What is a time correction? Now you might ask. A time correction in a stock is a particular phenomenon in which the stock gives no particular return over a long period of time. For example, say a stock's value is rupees 100 in 2014, and up till 2018 also the stock's value is 100. So we can say for 4 years the stock has absolutely given zero returns. Even though in this period of time the stock might have reached higher values, it might have traded at lower levels than 100, but on a 4-year basis it gave zero returns, which meant that the stock traded sideways and it underwent a huge time correction. Okay. Now we'll look at one more important valuation metric which really comes into handy when you look at banks, which is known as the price to book ratio of the bank. Okay, the price to book ratio of HDFC Bank is currently at one of its lowest levels. It is currently at a price to book of 2.9. Now, given that this is India's largest private sector bank, which normally used to trade at a price to book between 3 to 4, this price to book of 2.9 is absolutely one of the least that this has ever traded at. So this also indicates that from a book value basis also that HDFC Bank is trading at a huge discount. Now what we'll do in this part, we'll try and find out the reasons why HDFC Bank has been undergoing this severe time correction. So for that, let's do one thing. Let's go and check on the internet. In this particular article I found on Economic Times about why HDFC Bank is currently falling. So they said that the main reason for this fall is because of investor sort of sentiments or analyst sentiments, you could say, and nothing to do much with the company's fundamentals. I'll explain this to you. See, HDFC Bank and HDFC, which was the housing finance department of HDFC, both of these actually did a merger. So after the HDFC and HDFC Bank merger, what happened? So after the merger of HDFC and HDFC Bank happened, there was an increase in the loan to deposit ratio of this combined entity. Okay. Now I'll explain what this is. See, the loan to deposit ratio is basically the ratio of the loans which the company is giving out to its customers and the particular deposits in the form of say current accounts and savings account which the particular bank has with itself. Generally, what the RBI wants, they want that the loan to deposit ratio should ideally be between 70 to 75 for banks to work on a comfortable level. But post the merger, what happened? This particular ratio for this combined entity reached 110. Okay, this meant that it had a, before the merger, HDFC Bank used to have a loan to deposit ratio between 85 to 89%. Okay. So this means that once this particular ratio crossed 110%, there was a fear among the analysts, among most of the people in the, in the banking sectors, that this was not sustainable. See, if you do not have higher deposits than your loans, then it becomes very risky for you to give out loans, right? So what HDFC Bank would need to do in this particular case, they would need to gather more deposits, right? So since HDFC Bank would have to gather deposits at a faster rate, what would it do? It would offer fixed deposits, it would offer other recurring deposits and other sort of deposit products in which the particular interest rates would ideally be higher, right? Since the interest rate would ideally be higher for the end customer, the net interest margin of the bank would struggle. So as I mentioned, since there would be a pressure on the names, they felt, see read over here. There are apprehensions that the situation might force banks including HDFC Bank into margin pressure. What are these margins? This is basically the net interest margin. If they aggressively mobilize deposits, clearly because they have to give out loans to the end customers at one prefix lend, and they would also obviously want to have more deposits in the bank, so they would offer more lucrative depository products. So this would basically lower their margins. So in this particular case, people felt that unless HDFC Bank somehow controlled their NIM and also grew their deposits to lower the LDR, there would be a difficulty for the bank. And this was also seen in the third quarter when the bank reported a gross loan growth of 4.9% sequentially, but the deposits grew only at a modest 1.9%, which means that this would aggravate the current LDR. Okay, and also the management after this particular meeting said that they would take around 3 to 4 years to fix this particular situation. Okay. Also, one more very important thing for you guys to notice over here, that HDFC Bank's NIM, which used to initially be at a range of 4 to 4.1% when it was only HDFC Bank and when it was not merged with HDFC, but now after the merger came down to 3.4. So the people in the community kind of felt that unless HDFC Bank's NIM recovered to that 4% mark, it did not deserve the price to book, which of 3.5 to 4.5, between which it normally used to trade. So basically till now you understood why there was a negative sentiment. First of all, the LDR ratio crossed 110, which was much higher than what the 70 to 75% level of what RBI mandates. Secondly, there was a pressure on the net interest margins because people thought that HDFC Bank has to grow their deposits, so that is why there would be a pressure on the bank. Thirdly, a little impact was also seen in the NPAs of the bank, because the entire AUM of HDFC also merged with HDFC Bank. So in that particular case, the NPAs also slightly increased, but it was a marginal thing. And fourthly, the CASA, or the current account and savings account deposits of the bank, that was also an issue, because HDFC Limited did not have any CASA sort of a thing because it was not a bank. So once their entire assets under management came under of HDFC Bank, obviously the CASA of the overall merged entity as a percentage declined. So these were some of the most important things why HDFC had a negative sentiment. Now let's look at what were the positive things which came out of this particular merger, and how this might lead to HDFC Bank giving stupendous results in the future. So let's look at that. So look at this. First thing what we'll do, we'll come to this by a report by HDFC about its merger. So what we see over here is, that HDFC Bank alone has 93 million customers. There are 3 million more unique customers coming from HDFC Limited. Okay, HDFC Life has another 6 million. HDFC Mutual Fund has 8 million. These are all unique customers which this particular segments have. So after this particular merger, what is going to happen? There will be a huge opportunity for cross-selling. So say there is a particular customer who comes to HDFC Limited for say a home loan. Okay, just an example. Then he can be sold additional sort of fixed deposits, additional sort of mutual fund offerings, because now they are interacting and connected with HDFC Bank. So there is a huge chance of cross-selling. And once cross-selling increases per customer, the per customer lifetime value of that customer will keep on growing. So this will directly impact the revenue that HDFC Bank will generate per customer, leading to a positive impact even on their bottom line. Secondly, what will happen? More customers coming into the fray, leading to more targets for HDFC Bank, and also this will help in leveraging the distribution network of HDFC and HDFC Bank. Okay, so this will create a lot of synergistic benefits for HDFC Bank overall. Also look at one more very interesting thing. Look at the pace at which HDFC Bank is currently increasing their branch network. Okay, in December 2022, they had a total of 7,183 branches, which increased to more than 8,000 branches by December 23. That is, in 1 year they increased more than 1,000 branches almost, which is phenomenal. Okay, in fact, the amount of branches that they opened in 1 year was more than the total number of branches in several of the country's other smaller banks. So this indicates the rate at which HDFC Bank is setting up for its next phase of growth. Okay, it is also opening a lot of branches in the semi-urban state. Okay, there has been a lot of branches which are opened in rural India of HDFC Bank also right now. And also because of this merger and the synergistic benefits of it, they have a huge number of customer base. So they had 85 million customers in June 23, which has increased to 93 million. So an addition of 8 million extra customers because of the merged entity right now. The bank also recently gave a quarter 4 update for FY24, in which it said that its gross advances of the loans that it gave out rose by 55% on a year-on-year basis, and its deposit also grew at a considerable 26%, which is a great thing. Post this, the stock price also increased by more than 3%. Also, one more important thing was that the domestic retail loans grew by 108% year-on-year and around 3.7% quarter-on-quarter. So this indicates the rate at which HDFC Bank is aggressive right now. Okay, now let's look at something very interesting. Okay, now let me show you guys something very interesting. Say HDFC Bank, if we come to trading view, okay, HDFC Bank has not given any returns. Current price is somewhere over here. It has not given any returns since this particular date. This is around Jan 21. Okay, 18 Jan of the year 2021, which means this is almost 3 years and 3 months now, right? So let's see what was the profit or the net profit of HDFC Bank at that time and what it is currently. So we'll go to screener. So 18 January 2021. So let's take, for the sake of calculation, the March 2021 results only. Okay, at this point of time, HDFC Bank's net profit was 8,444 crores. So it was 8,444 in March 2021, and currently in December 2023, this is at 17,718, which means that this has doubled. Okay, this has actually doubled, and if you look at the latest quarter results are not out, it will be out on 20th of this particular month. I expect that this would be even higher, somewhere around the 18,000 or 18,500 crores. So this will be something which is more than 2 times its profit growth in the last 3 years. So where has the stock been? Ideally, if it were following the earnings of the company, the stock price should ideally have doubled from here, which indicates to me, if the PE of the stock did not degrade, if it was continuously growing, the stock price should have followed, and the value of the stock ideally should have been somewhere more than 2,000, more than 2,500, logically, right? But where is it? It is currently at the same price. Also, I'll tell you something very important. Let's go down over here. See, for bank stocks, you really do not need to look at all of these factors which are here. I'll show you something. Say, you don't need to look at all of these for banking stocks. What you really do need to look forward to is what has been the particular thing with the promoters, FIIs and DIIs, right? So obviously promoters, zero, whatever, 25.5% it was there with the promoters on June 2023, they actually sold it off and it was entirely absorbed mostly by the FIIs and DIIs. Okay. But what I want to show you guys is over here that FIIs have slightly cut their positions in this current particular March 24, shareholding pattern release. They have slightly cut their position, but most of their cut has been absorbed by the domestic institutional investors. Okay, now DIIs are basically the country's mutual funds and ETFs. So most of this particular thing has been absorbed by them, as we can directly see that this has grown from 30 to 33. Slight increase has also happened in the public shareholding. Okay, so increase in the public shareholding has actually been something which has been playing in the stock price of HDFC Bank. I'll explain how that is happening also to you guys. So as you can see, from June 21, okay, 50 lakh people had actually HDFC Bank shares. Now that has increased to 41 lakh people, which is actually almost close to 3 times the number of retail people into the stock. And this is directly affecting the stock price of this particular company. How? See, HDFC Bank over the last 3.5 years has been constantly moving in this particular range. It has been doing a range bound price action activity. So the lower range generally has been around this 1350 mark, and the higher range has generally been around the 1720 or 1700 mark. So whenever the retail people in this market, because it has not been entirely driven by the by the FIIs much, whenever the price of the stock fell to 1350s level, all of the public felt that the HDFC Bank was very cheap in the market, and they used to buy the stock. And immediately when the stock price would rally to 1700 levels, they would feel that it was overpriced and they would sell the stock. So the most important thing right now is that you need strong institutional buyers to push HDFC Bank's stock price break above this 1720 level. See, it tried to break over here, it tried to break 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 here. 5 times it has tried to break the 1720 levels over the last 3 years and it has failed. So you need strong buying whenever this particular thing breaks. Also, something very interesting I'll show you is, you'll ask me, Rohit, is there any natural pattern forming, right? Is there any natural pattern forming in the stock? It is. There is a technical pattern forming other than this range bound. It is a clear cup with multiple handle pattern. See, this is a cup, one handle here, another handle here, and again it broke down, and I think it'll again go over here, and if it has to break, it has to break from here. So what is the ideal target from this cup with handle pattern? If you ask me, the ideal target from this cup with handle pattern is coming out. If you draw it down from here to here and you escalate it over here, this comes out to be around 2167. Okay, which means that from the current price that HDFC Bank is currently trading over here right now, okay, current price that HDFC Bank is trading, the upper end of the 2167 target is a 44% high, 44% growth you can see in the price of the stock over the next 6 or maybe 1 year, which is highly possible if the stock breaks out of this 15, 17, 20 range. Also, this is why I was telling you at the start of the video that this might be one of the best times to buy HDFC Bank. Also, one other very important thing I'll show you. Also, there is one more very interesting thing which I'll show you guys. HDFC Bank isn't trading at a PE of 16.9. It is trading at a PE below that. Below 16.9. How? See, if you look at the forward price to earnings of HDFC Bank, how do we calculate that? Okay, very easy. We come down over here, we see that HDFC Bank has currently, from March 23, given P's of 22, 22.7, 22.17, 22.73, right? Okay, so we have got how many quarters over here? We've got 1 quarter, 2 quarter. Sorry, we've got ignore March 2023 from here. See, we've got 1 quarter, 2 quarter, 3 quarters. Okay, 3 quarters of 22. Now, given that this is December 2022, if we expect the bank to give a 20% rise in its earnings per share, so this 22, let's use calculator and show you. Let's use calculator. So a 22 multiplied by 1.2, 20% rise. This gives a 26.4 EPS in this particular quarter, plus 22 plus 22 plus 22. So this is the EPS of HDFC Bank for the entire last year. This comes out to be 92.4. Okay, and HDFC Bank's current stock price is 1509. Okay, so what I'll do, so 1509 divided by 92 gives me a PE of 16.4, which means that this is lower than even this 16.9, right? So HDFC Bank on a forward basis is even cheaper. So this is the reason why HDFC Bank is currently in a very favorable state to buy. So I hope you guys understood what I wanted to say. You can see that there is a possibility of HDFC Bank growing by more than 40% in the next 6 to 12 months, given everything goes probably. Obviously, this is not an investment advice. This is purely for your educational purposes, so that you get to analyze the stock both from a fundamental as well as a technical point of view, and you make sense of what you want to do in the stock market. So this was regarding HDFC Bank. It's one of the most cheapest, I would say, private sector banks in India right now, given that its net profits and everything is going to grow at very high rates, given that it now has a higher base effect. It has the synergistic benefits of HDFC Bank merger, which happened recently. So that is why the financing profits will grow. NIMs will obviously recover over a period of time. But the brand level at which they're growing their branches, the level at which they're expanding, clearly indicates that they are focused highly on the top line, as well as both on their advances and their deposits. So this is a great time that the people in general are ignoring HDFC Bank, but you might not get a better time to invest in this bank once the rally begins, right? So this was regarding HDFC Bank. If you guys found this video to be very useful, please drop a like and subscribe to my channel, and I'll see you soon with another analysis in some time. Bye.